Welcome to our comprehensive guide on mastering call credit spreads. In this video, we're going to break down exactly how to use this powerful option strategy and take your trading to the next level. Call credit spreads are an excellent way to generate income in your option trading portfolio and reduce risk. So whether you're a beginner looking to learn about how to place call credit spreads or an experienced trader looking to level up and refine your technique, this video's got something for you. We'll dive into the fundamentals of call credit spreads and how they work, selecting the right strike prices and expiration dates, managing positions for max profit, advanced techniques for risk management, and then we'll jump into a live trade on the option trading platform. So if you're ready to unlock the secrets of call credit spreads, stick around. By the end of this video, you'll be able to execute this strategy like a pro and up your option trading game. Be sure and hit that like and subscribe button down below so we can get this video out to more people. Also, download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. All right, what is a call credit spread? A call credit spread is a limited risk, limited reward options strategy where a trader sells a call option at a lower strike price and buys a call option at a higher strike price with the same expiration date. This results in a net credit to the trader's account. And when do we use this strategy? Call credit spreads are typically used when a trader has a neutral or bearish outlook on an underlying asset or stock. They're best employed when you expect the price to remain below the lower strike price by expiration. So what are the components of a call credit spread? We first sell a call just higher than the current stock price out of the money. And then we buy another call further away from the money or the current price for protection. And for doing this, we collect a credit. We do this in the same expiration date. The max profit in this trade is the net credit received as soon as you place the trade. And the max loss is the difference between the short and the long call option minus the credit received. By the way, if you want to receive a free options guide with all the option strategies and how to manage them, drop a comment down below, options guide, and I'll send you the link. So how do we select the correct stock that we want to sell a call credit spread on? Well, liquidity and trading volume is key. We want to select a stock that is very liquid and trades a lot. This way, there's very little difference between the bid and the ask spreads, and we're not giving up any money. Implied volatility also matters. The higher the implied volatility, the better it is because we collect higher option premium with the higher volatility. And analyzing the sector and market trends is key. We want to be in a stock that is in a sector and the stock has been overbought and it's at its highs. We don't want to do this with a stock that's already down. We're looking for the stock to move down in price or stay where it's at. All right, let's take a look at Walmart, ticker symbol WMT. We can see it's trading at almost 84, 83.91 right now. And the 52-week range right here is 49 to 85. So we are at the top end of the range. And look at this is the 5-year chart. It's way up here at the top. The 1-year target estimate that Yahoo Finance has is 86. So they're looking for it to move $3 more over the entire year. The PE ratio is high at 43. So I'm not looking for this stock to skyrocket up. I think there's a better chance that it's going to have a bit of a pullback. So in order to balance out my portfolio, I don't want to have just all long trades on, hoping the stock market continues up. It's at highs right now. So I want to have some trades on that will benefit when the stock market moves down. And it will. The stock market moves up and down. So Walmart is the stock that we're going to trade. Let's go to the Tasty Trade platform. There's a link down below. I use Tasty Trade and Moomoo. Check out the links. Use the links. There's benefits if you do. And they're both great option trading platforms. Walmart. Okay, again, here is the chart. You can see the Bollinger Bands. It's at the top end of the Bollinger Band. That means it is overbought. So there's a good chance that it will move back down. Here's the 200-day moving average in yellow and the 50-day in red. and then the 13 days. So we're way up at the top right now. So I am looking for a pullback. We go to the trade page right here, and I like to look out about 45 days to expiration, between 30 and 45. So we're going to go to the 43-day December 20, 2024 option chain, open that up, and calls are on the left here, puts are on the right. Now we're going to sell the closest out of the money call. That's the 85 strike, and we will collect $2.59 for doing that. And then we'll buy the 95 strike as protection. Now that's going to cost 36 cents. So we collect $2.29, which one option contract controls 100 shares of stock. So that's $229. As soon as we hit review and send, this pops in our account and we make $229. Now we only keep all of that if the stock price remains below that 85. So we can go to the curve mode right here and we can hit analysis, and then you can see right here the profit area. So if the stock price stays where it's at, we keep that full $228. If it moves up a little, we still keep it. And our break even is way over here. Our break even is the 228 if you add it to the 85. So it's 87.28 is our break even price. So we can have the stock move up quite a bit and we still are profitable. Our max loss, remember, is the difference between the short and long call. So that's $10 minus the credit collected. So it's got right here 772. That's $10 minus the 228. That's the max loss. Max profit is the net credit collected, $228. We have a 66% chance of making a profit. POP stands for probability of profit. We hit review and send and place the trade. Hey Darren, isn't this risky? How do we manage risk? Well, position sizing is number one. We want to determine the appropriate allocation in our portfolio. So I don't like to place any trades that are more than 5% of my portfolio on any one option trade. So depending on that and the size of your account, you may have one lot on, or two lots, or three lots. And diversification is another factor. We can have multiple spreads, but no more than 20% in any one sector. So we want to stay diversified. I wouldn't put everything in, for instance, ExxonMobil and just have oil stocks on. You know, you might want a healthcare or an industrial. Different sectors is always a good way to diversify. And then we also want to close or roll our positions at 10 to 15 days to expiration. This avoids gamma risk. As we get closer to the expiration, the gamma risk, or the acceleration of the premium, goes way faster. So we want to roll it 10 to 15 days into the next month if we still want to keep the trade on and collect more premium. How do we manage our call credit spread, and when do we exit the trade? Well, we've got to have certain profit targets. So the way that I manage the trade is, if I have a quick 50% profit in just the first few days, then I'll close the trade and just get out of it. I'll look for a new trade. If not, if it takes a little bit longer, which is typical, then once it gets to 10 to 15 days to expiration, I'll go ahead and close out. Or if I still want to have the position on and I still think that it's going to drop further in the future, then I'll roll out and collect more premium. If I'm tested, in other words, if the strike or the stock price moves up and test my short call, gets close to it, then if it's right there and there's still 15 to 45 days to expiration, I'll do nothing. I'll stand pat, because there's a high probability that the stock price will touch the short call. But hey, it may drop right back down. But if it is tested and we are in that 15 to 45 days, I'll either close out, or I can close out and then move my strike prices up. I pay a debit for that, but often that's the best move. And at 15 days to expiration, we can roll out or roll up and out in order to collect additional premium. If the premium drops or the stock price drops and I profit, I just close out the trade and move on and look for a better opportunity. That's always good because, hey, we want to make profit, right? Hey, Darren, can't we be assigned the stock when trading call credit spreads? You sure can. Assignment can occur when your short call strike is breached. In other words, the stock price moves up higher than the short strike. The more that the strike is breached and the closer to expiration, the higher the probability of assignment. As long as you roll outside of that 15 days to expiration window, assignment can generally be avoided. If assigned, no big deal. Just close by selling the long call at the same time along with the stock that you were assigned. It's really no biggie. Now, I already talked about using call credit spreads as part of an overall portfolio strategy. So we're not only making money and betting that the stock market keeps going higher and up, we can make money with call credit spreads on the other side when the stock market moves down or the underlying that we've got the call credit spread on moves down. So one other strategy that we can do with the call credit spread is turn it into an iron condor. And we do that by, just like selling the call credit spread on the upside, we can sell a call or a put credit spread on the downside. And it works exactly the same. It's called an iron condor. If you want me to do a video on iron condors, just drop a comment down below and let me know. Okay, so when do I put an iron condor on and sell the put side? Well, generally, if there's a big move down in the market and my call credit spread profits, sometimes that's the time that I'll put on that put credit spread because there's already been a move down. The likelihood that it's going to keep going down, you know, it may be better. There may be a better chance that it stays where it's at or even moves back up. So I'll throw that on and collect additional premium. All right, guys, let's do a quick recap of what we've covered. We started out with the basics, explaining exactly what a call credit spread is, why we use it, and how it's placed. We talked about selecting the right underlying stock as well as the correct expiration date and right short strike call option and long strike call option. We then talked about the ways to manage the trade when it's tested or close it out for a profit or roll out to the next month and collect additional premium. All right, make sure you remember to hit that like and subscribe button down below. Remember to drop a comment. Let me know what you're trading and if you're using call credit spreads. Remember to download the free options workshop in the link below. And thanks for watching. I'll see you in the next video.